There's a myth out there that's being spread around by the media, by stock market, supposedly experts, and Wall Street, that somehow the last decade was lost. I was even on Fox 35 last week explaining the fact of this, and also commenting on a research study that was published that says that investors are shying away from the stock market. Now, however, I wanted to take a real look at this and put it into its proper perspective. At the end of the show, you will find out if this decade or this last decade was truly a lost decade. Okay? Now, there's no question that 2000 to 2009 had lots of peaks and valleys. Okay? And I had a lot of emotional roller coasters for investors as well. But this is not at all uncommon in the world of investing, especially when you throw equities or stocks into your portfolio. But let's understand that the index returns that many of these experts talk about are not always necessarily true market returns or even investor returns. For starters, when the media refers to the market, they most often refer to three places: the Nasdaq, the Dow, and the S&P. Okay, but the reality is that none of these indexes actually measures the true overall market. Okay, for three reasons. Number one, indexes measure only a portion of the returns that come from stock appreciation. They ignore dividends paid from the stocks inside of these indexes. This may not sound like a lot, but compounded dividend gains have amounted to more than half of the total returns over the long term for investors. Number two, we got to understand that these indexes leave a lot of stocks out. Folks, Dow is only 30 companies. Okay, the Nasdaq is only about 20% of the U.S. market, and the S&P 500 is 500 companies. Okay, this leaves out thousands of small and micro-cap companies that are very important for the diversification and return of your portfolio. In addition, none of these indexes take into account any foreign stocks. Thirdly, one of the things we have to look at is that most people, hopefully most people, didn't really place all their money in the U.S. stock market. We would consider this not a smart move, to be politically correct. Instead, if you understand, as our clients know, our clients own a globally broad, diversified portfolio, okay, which contain foreign stocks. They contain bonds, CDs, real estate, natural resources such as oil and gas, in addition to U.S. stocks. Okay, such diversification proved its worth, as gains in some asset classes were able to offset losses in others. Okay, so now let me tell you what really worked this past decade, and then let me tell you what works in every decade. Number one is called asset allocation. Asset allocation always worked and has always worked. And what this means is diversification among various asset classes, which of course we preach and preach about constantly. Secondly, rebalancing. Okay, what rebalancing means is getting your portfolio back to the intended allocation. Okay, and what happens is during the growth of your portfolio is that at times when equities are performing poorly, the bond portfolio, the fixed income portion of the portfolio might become overweighted. At times when the market is doing really good, the market portion of your portfolio becomes overweighted. So we have to go back and rebalance that and get back to the intended allocation of the portfolio so it doesn't get out of whack. But let me tell you what really killed it over the last decade. For those of you who continue to invest, that means putting in money consistently, whether it be the 401k or IRA or other accounts, okay? Those people took advantage and exploited what is called dollar cost averaging. Dollar cost averaging allows you to buy more shares in an investment, and we especially exploited it because during a lot of periods, 2008, and other periods during the decade, we were able to buy shares really when the market had gotten beat up. Okay, so dollar cost averaging really allowed us to take advantage of those dips in the market, and over time we will really see the appreciation of how that has worked. Now, Fidelity Investments, one of the largest 401k sponsors in the country, analyzed 11 million 401k participants over the last 10 years and found that those who continued to invest in their 401ks starting in 1999, and they continued throughout during the 10 years after 1999, had account balances of nearly 150% higher than they actually were in 1999. And why was that? Well, it was because they continued to put money in, and their employers put money in through employer matches. So what have we learned from this? Well, what we've learned is that even though the market over time provides generous returns, few of us have the ability to really take advantage of it. Why? Because mainly of bad behavior. Humans were humans, okay? Panic sellers, we get emotional, you know, that constant bad behavior that I talk about. And the other reason is most investors use what's called active management of their portfolios, which means they use high-cost portfolios, and they employ these professionals, supposedly these gurus, who think they can buy and sell and market time the market. And it's always been proven to fail, okay? So what do you need to know for not only the next decade, but let's say the next 100 years? You have to understand that, number one, the market, okay, the markets still to this day are one of the number one best wealth creation tools out there, okay? Number two, you have to stay invested and control your emotions. Let market forces work and don't fight them. Generous returns in the market have been proven to be there for the taking. You just have to be patient. And number three is you have to have a plan, and you have to stop falling for gimmicks, okay? There is really no magic out there. There's no magic to this, folks. The financial industry wants you to constantly stay confused, okay? You don't have to when you have a plan and you have a coach. And last but certainly not least, understand that no one knows where the next 20% movements in the markets will be, okay? But the next 100% movement will always be up. The markets have seen many declines, which have always been followed by recoveries, okay? But we've never suffered a 100% loss. So remember that anything short of a global catastrophe such as a meteor shower, global war, the earth being swallowed by the sun, okay? These are, of course, these are rare, but it will be rare for the market to see a 100% decline, okay? And if it does happen, okay, I said it was rare, but I didn't say it was impossible. If it does happen, I will tell you that your portfolio should be the least of your worries if this happens. Folks, not even gold will help you through that, okay? So this all goes to show you that it is possible to create wealth no matter what is happening in the economy. And no matter what, you need to continue investing for your future, okay? Thanks for tuning in, where we help you build wealth, ignore Wall Street, and get on with your life.